Okay, good morning, everybody. Welcome to the May webinar. We're already 5 months in through 2024. Today, we are looking at the latest data. We're looking at what we know for the rest of the year. I've got a couple of new views for you if you've been on these webinars before. We're going to dive in. The market around the country is really kind of fascinating right now. I've called it mixed signals, and it's really differences in local markets, different parts of the country behaving very differently. I'm going to show you where that is and which parts of the country are slower and which ones are actually kind of surprisingly hot right now. We've some of that data is evolving quickly, and so we're going to dive into all of those things today. As always, we use a chat window. So use the chat. Let us know where you're connecting in from today. We can also look for Lael and Jeff from the Altos team that are in the chat. As I'm talking, they will try to answer questions on the fly and drop links in there so that you can click through if I've referenced something that you might want to get. Use the chat window for that. I stick around at the end of the webinars to try to help make sure all the questions are answered. And as always, yes, we record. Everybody who's registered for the webinar will get an email later today when the recording is available. And you can always watch that on our YouTube channel. So yes, the webinar is recorded. As always, of course, Altos Research tracks every home for sale in the country every week. We track all the listings, all the pendings, all the new listings, all the pricing, all the supply and demand, all those metrics, and the changes in that data, and we make it available to you before you see it in the traditional channels. So what I like to do with the webinars, we get a chance to go through the whole country. We get a chance to go through a lot of data and help you communicate what's happening in the market with your buyers and sellers right now. We're in a world where mortgage rates are still over 7%, although last few days, maybe they're easing lower. And as rates have basically climbed all year long, that has put a damper on some demand. But there are parts of the country which are maybe cash heavy, cash buyers, and those parts are actually you could see a lot of demand in those, especially relative to still pretty low levels of inventory. On the other hand, there are parts of the country which have had a lot of inbound migration over the last few years or have rising property taxes and insurance expenses where you see inventory building now and price pressures down. So we really have a tale of two, maybe three markets around the country that we'll kind of look at today. So before we dive into the data, especially if you're new to these webinars and new to Altos, if you are trying to understand how to communicate about the data in your real estate business to buyers and sellers, to investors, if you're trying to understand the data that I'm talking about here, we have created an ebook. It's a free ebook, how to use market data in your business. It has scripts, it has ideas, it has how to understand the data. What are we talking about here? What are we looking at here? So if you haven't already downloaded the ebook, I highly recommend it. There's a link in the chat that you can click through to the Altos site and download that ebook. But if you're in this world where we're trying to communicate about this market to people who aren't paying that close attention, those folks who aren't paying that much attention to the data every week, they probably have no idea what's happening. They may have a very wrong idea about what's happening, especially in the local markets. And this is how we communicate. So they may be afraid to transact right now. And the data is the antidote to the fear. So I recommend the ebook, and let's dive into the data today. Let's start with inventory. There are 568,000 single-family homes unsold on the market right now. That's 35% more than a year ago. And inventory has been climbing each week since February. It's been climbing relative to last year for like since November. So it's, I don't know, 27 weeks or something like that. Each week, the gap between this year and last year is climbing. And one of the reasons for that is that rates are still higher than they were last year. So as rates are higher, the demand slows, and as demand slows, inventory grows. And that's what we're seeing across the country. We are seeing inventory climb pretty much everywhere across the country. And I'll show you in a second where we still have less year over year inventory, but pretty much everywhere. But there are some markets, in particular the South, where inventory is climbing dramatically, much faster than last year. And so across the country, we have 35% more homes on the market than a year ago. Some markets, it's barely more, 5% more, and some markets it's 60% more homes available now than a year ago. In this chart, each line is a year, and so you can see the normal curve. Inventory peaks late in the third quarter and then declines for the holidays and then restarts its climb in the spring. In the second quarter, where we are now, it is the peak home buying and selling season. So you get the most new listings per week. And as demand is a little muted, the inventory tends to climb. You can see the dark line is this year's curve, and you can see how it's spreading above the bright red one from last year. The pink one from 2 years ago, you can see right at this time, inventory was rising 3 or 4% per week when rates were shifting. So rates were moving higher, inventory moving higher. Rates are high now, inventory is high now. If rates fall, for example, in the second half of the year, they fall into the sixes, into the mid sixes, this trend with last year could reverse and therefore compress with last year. And inventory could peak, for example, if rates are falling in the second half of the year, inventory could peak in, say, August and start declining. So we will have what I'll show you in a minute is some forecasts and some other details about how to understand what's happening with inventory. So this is unsold homes, single family homes on the market. There are 568,000 right now across the country. And it's 35% more than last year. When we have year over year inventory gains like this, that shows supply, a change in supply versus demand, and that has implications for how we forecast home price changes out in the future. Climbing inventory year over year has implications for home price changes another 6 to 8 to 12 months out in the future. And I'll show you a little bit of that in a few minutes. So I mentioned that inventory growth is not even across the country. So if we compare now versus last year, still New York and Nevada still have fewer homes on the market now than a year ago. But Florida and Arizona have 63% more homes unsold on the market than a year ago. Texas and Georgia are around 50% more homes on the market now than a year ago. So some of these changes are still coming off the COVID lows. And you can see, though, the lighter the color here, the less inventory growth from a year ago. Some of the states don't have the numbers in them. That's just from scaling on the chart, but you can use the color. So for example, Indiana is about 25, 30%. Wisconsin is a little over 30%. You can use the color to gauge how much inventory gain is across the country. Now, if you've been watching these webinars for the last few months, and I show this chart each month, you'll notice that a couple months ago, New York and Nevada were like 25% fewer homes on the market than a year ago. And now they're like 2%. So in the next few weeks, I expect New York and Nevada to move positive year over year and start to show those year-over-year gains, and they've been moving very slowly. In fact, Nevada may cross over positive first. New York has been the slowest in terms of inventory growth, and another way to look at what's happening across the country is by doing months of inventory. So if we take the Altos weekly new pendings number and multiply it times 4, and then divide by the total active inventory, you can see really a tale of maybe 3 markets. So we have the South, where the redder states, 3.5 months of inventory that's climbing. And then we still have some of these states in the Northeast that are around 1 month of inventory. So, in Rhode Island, there's 2,500 homes single family homes on the market, and we sell 600 a week. And so in a month, that whole inventory turns over in that period. What we see in most of the country is that inventory is moving relatively quickly. This is one of the mixed signals. So we know that inventory is 35% more than a year ago, but we also know that these numbers, the months of inventory numbers, are not skyrocketing. So it's definitely something to keep in mind as we analyze what's happening. I think the most important view here is how you can see the South with the greatest months of inventory, a couple of the mountain, Wyoming and Montana, but really the South. We have this Northeast corridor, and then some of the mid section of the country, which is in a middle to stronger pace. What this tells me is that while we have inventory growing, there's no signal in the data of a massive inventory change, except maybe in like Western Florida, that would drive home prices down dramatically. So this is one of the signals that says, yes, inventory is growing, but inventory is growing because we're moving out of the lock-in period with fewer people locked into their homes now. And because we've had 8 million people more buy new homes with higher mortgages. And it also shows like cash buyers. So, a lot of the California markets or Seattle are driven by cash buyers right now. And I'll show you some of that in a second. So what it allows us, the takeaway here is that while inventory is growing, we can see not too much, not a great spike. And we can also see that there is enough demand to keep things on the rails. It also implies to me, if rates fall, we know there's a ton of demand on the sidelines the demand picks up faster than supply, and that'll drive home prices higher. It'll drive transactions higher, and inventory down. Okay, that's what we're looking at across the country. And if we look at the new listings view, there's 69,000 new listings this week. We may have peaked past our peak new listings 2 weeks ago. We'll see. Hopefully this week we get another little last bit of May of more sellers coming in. What we can see here is each line is a year. There's some squiggles there. The gray ones are past years. And you can see how in good years, healthy years, we have maybe 100,000 new listings unsold that in a given week. And and these are single family homes. What we have right now are 69,000. It's more than last year. So we have 10, 12, 20% more listings each week than a year ago. And that's one of the reasons that inventory is growing, but it's also one of the reasons that transaction volume can grow. We have more sellers, means more sales can happen. Last year, look how the light red line from last year was below, like so far fewer sellers than any recent year. And so we're finally getting back into closer to normal. It's still pretty restricted. And again, this is another signal that, there's not a flood of sellers anywhere. There's no risk of like skyrocketing number of sellers and therefore prices crashing because things are way out of whack. And I think what we have instead skyrocketing is if we have multiple years at higher rates, that leads us to generally more sellers, more inventory each year, and we can build over time. So this is the new listings per week view. And we track not just the new listings, but there's a set of properties that get newly listed and are already in contract a week later. So it's just a few days later. There are always, and we call these the immediate sales. So there are always immediate sales in every market. But during the pandemic, the immediate sales were like 25 or 30% of the homes were going into contract in less than a week, and they're not adding to active inventory. So what we've got here is the new listings volume, and then the pink part, the light color portion, those are the immediate sales each week. So the total number of new listings was 90,000 this week, but 21,000 of those are already in contract. And we can see a couple things. One is we can see more sellers than a year ago. We can see the pink portion is actually a little bit bigger than a year ago, meaning more immediate sales than a year ago. And that means that we have, again, it's a signal that says while we have inventory growing, we have new sellers growing, we can see that the demand is mostly there to absorb that amount, those sellers. And it is why there's no grand fear of like a flood or too many of those going. There are some price pressures as we have inventory growing. We can see some price pressures about future sales prices, and I'll show you those in a couple of minutes. What I want to do is the last final step on looking at inventory is we can track the coming soon. These are properties that are not yet listed for sale, but they're marketed as coming soon. And 3,400 coming soon properties we tracked this week. And not every market and not every home does this, but like the good ones do. And what we can see is there's more coming soon properties than a year ago, still fewer than 2022, which is the top line. In the first half of 22, rates were rising and everybody knew it. By May, if you didn't have your house listed by the end of June, you knew you were behind the curve. And so everybody who was thinking of listing in May and June of 22 put a coming soon sign on. And so you could really see where that inventory was being pulled forward, trying to get it done in the first half of the year. If you didn't have your house listed by July 1, you can see this big dip in the middle of the pink line here. Now it's after July 1, and people are like, well, we missed our window. Rates are already up and they're still climbing in the second half of the year. That was telling us right there was a leading signal that we weren't going to get a surge of inventory. We could already see people saying, we're not going to sell. And so it was a real immediate view here. And what we see now is each week we see more coming soon listings than a year ago. So we can see that our coming soon listings is going to, our inventory is going to continue to expand. We can also see that coming soon listings is kind of leveled off in the last month. And because it's leveled off in the last month, that implies that we may have already seen our peak of new listings for the year, unless we get like rates drop and we see some of those coming soon people, maybe they say, I'm going to try to take advantage of it. But but we're still showing the future listings that haven't been listed yet, growth over last year. And I think that's the most important message. You may have noticed in the last week, 10 days, we published a new research paper. The lock-in effect is, I mentioned already today. What we've done in this research paper is we've taken other people's research, we've taken Altos data you can't see anywhere else, and we're measuring what do you need to know about the mortgage rate lock-in effect. The lock-in effect is everybody's got 3% mortgages, and now it's 7% to buy a new home. Maybe I'm never going to sell my my existing house. Maybe I'm never going to move. We can see obviously that home sales dropped in 22 and 23. We can see, and so we can see the lock-in effect. In this paper, we've done a few things to try to illustrate points that I make and observations that we can tell about the data. One of the observations is that when rates rise, inventory rises. When rates fall, inventory falls. And what we've got here are 5 periods over the last 7 or 8, 10 years. We have the red dots on the left are rates were falling. For example, January of 2019, the year 2019, rates fell by 200 basis points and inventory fell by 600,000. Over here on the far right was that period, the last 2 years, rates rose by 500-600 basis points and inventory rose by 300,000 units. So you can see a really direct correlation. When rates rise, inventory rises. When rates fall, inventory falls. And it's counterintuitive to a lot of people. A lot of people think when rates finally fall, we're going to finally get some inventory again. But it turns out that's not true. And for home buyers, if you have home buyers on the sidelines, the message is that, look, when rates fall, there's a lot of home buyers on the sidelines. Your competition increases. The demand increases more than supply, so inventory will fall again. And that is not what a lot of people are thinking. And so we put this together, this paper on the lock-in effect, so that you can understand how to navigate and what to expect in the future. The paper is available now for HousingWire Plus members. So subscribers to HousingWire. It's a HousingWire paper. And there'll be a link in the chat where you can go click through and download it if you're a member. And also for members, we'll do a webinar tomorrow. Sarah Wheeler and I will do a discussion on the 8 big insights that the paper unveiled. So if you're not a member, you can join and be an HW Plus member. And get that now. And I'd love to see you on our webinar tomorrow if you want to spend a little more time on the lock-in effect. But when we put it all together, we can now forecast the inventory for the rest of the year. And in this chart, the black line is this year and the dots for the rest of the year. And assuming we don't have a dramatic drop in mortgage rates, because if rates fall, inventory will fall. We can see how we're going to end the year about 25% more homes on the market than a year ago at about 623,000 homes. So that's a fairly comfortable growth over 2023. We can see that we're not going to get back to pre-pandemic years. 2019, for example, we're not going to get close to 1 million homes or even 800,000. We could see the year ending at about 25,000, somewhere in that range. We adjust this forecast every week when the latest data comes in. And so if rates jump from here, maybe inflation data comes in stronger. If rates jump from here, this number will scale up. If rates fall from here, this number could scale down. That's what we're looking at for the year. It is growth. And it also means the big takeaway here when we're projecting inventory is the question is, when do we get back to normal levels, the old normal levels across the country? And we get back to those levels with multiple years of higher interest rates. So we get back to a normal level of selection for buyers if rates stay in the 6s, in the 7s, if they go higher into the 8s. That's how we get back to the old normal. If, on the other hand, rates fall down into the low 6s or into the 5s, expect our inventory to compress again, so that demand will increase more than supply and that competition will heat up. All right, let's switch to the pendings now, the pending side. So there's 72,000 new contracts pending for single-family homes across the country this week. That's about 7% more than a year ago. It's a little bit It's still 10 to 15% fewer most weeks than 2023, but we're just getting a little bit of growth year over year. It's interesting in this view. So each line is a year, and you can see there's a little week to week bounces, a little noise in there. Um, but if we are lucky, we have more supply, maybe we get some rates dropping, and so that spurs the demand in the second half of the year. We could see some points maybe in the fourth quarter where we have more sales this year than even in 2022. In 2022, I highlighted in the gray vertical bar there, in September of 22, we had a mortgage rate jump that jumped from like the sixes to 7.5. And in that moment, buyers put the brakes on again. So they'd already slowed in the first half of the year, and then they got a double whammy hit in September of 22. And you can see how quickly the new contracts fell in September and October of that year. And so if we're lucky and we get the reverse happening in the second half of this year, you can see transactions would pick up, and we might end the year with more sales happening than even at the late 22. Late 22 finished lower even than last year, and that set us up for that really low year of transactions all year in 23, right? So we started with very few transactions happening, and therefore 23 started, and the whole year was muted in sales. When we look at all of the homes in contract, it's a little easier to read. There are 393,000 single-family homes in contract. That's 2% more than last year at this time. So a little bit of sales growth. One of the things that's happening is that homes are the days in contract is falling compared to last year. So things are moving a little more quickly. I think that's from a few things where the market is stabilizing. So there are fewer people that are delaying or financing failing than a year ago. There's also more cash buyers now. So sales can happen quicker. And as a result, there are fewer homes in contract. So they go through contract a little more quickly, like down from close to like 38 days down to 33 days in contract is what we're measuring now. We can still see that there's 15% fewer homes in contract than in 22. We can also see July of 22, and again in that September, October window, fewer homes going into contract. And so the number of sales was dropping dramatically in the second half. That's the light red line in the second half of 22. If we're lucky, we have a better second half of this year, and we end up with more homes in contract, and we can have some obvious sales growth. There's a lot of folks who report home sales. For example, the Mortgage Bankers Association, using their mortgage purchase applications index. That number is still not showing growth over 23 over last year. And I think that's because we have a shift to slightly more cash buyers. So the mortgages we're not doing more mortgages yet, even though we are doing more home sales transactions, slightly more. And this is with rates stable around 7. And if they fall again, we could see a nice little bump of the transaction volume so that other folks are starting to report home sales gains as well. Here's days on market. Days on market is a little bit higher nationally than a year ago. Some markets are still moving very quickly, and I'm going to show you the regional differences in days on market very soon, and price point differences. But 59.6 days average for all the homes, and so it's slightly ahead of. So each bar here is a week. The taller the bar, the more the days. And the little dotted line shows you where last year at this time was. We have things take longer in the first quarter, where by July we're at peak year, and then in the second half of the year now, stuff that's sitting around days on market starts climbing again. You can see back in 22 and 21 where the chart starts here, how fast things were moving, at those peak days, just 3.5 weeks on average for homes across the country. So we're faster, slower than that now, and a little bit slower than last year. This is one of the reasons that inventory is building, because homes sit around a little bit longer on the market. Let's switch to pricing. The median price of all the homes on the market is $450,000. So what I'm doing here with the prices, so if you walk into the market today and you look around the country, the median price of the homes you can buy is $450,000. It is actually exactly the same as it was last year at this time. 0% home price increase. In some markets it's up, in some markets it's down, but it is unchanged versus last year. Now, these are the asking prices. So homes are on the market now and they get an offer in June and they close in July. These are like July sales prices. So you can see that in the future, this is a signal that sales prices will be compressed a little bit. If you look at if you look at the headlines are for home sales are lagging. They're reporting for April and March and April and even February. I think Case-Shiller is still February. So those are still showing 4, 5, 6% home price gains over a year ago. The lagging numbers are. And so in a leading indicator, we can see that the difference between this year and last year is compressing. That's because there's more inventory. Things are moving slower. Buyers have more options. So we can see that is happening. Last year, we could see that the gray area here was in 2022. This was when sellers coming off the first quarter, buyers were still buying everything they could while rates were great. Rates in the second quarter, rates were slowing down, but we still knew that they were going to get worse. So buyers were buying everything they could still, and that was pushing prices higher. That's the light line. See how quickly it was rising in 22. It peaked at like 455,000 or 457. And so the question is, will we peak above that this year again? As of right now, that's a leading indicator. It's one of the reasons that I'm looking at the end of the year, the home sales prices, not showing 5 or 6%, but maybe showing 3% or 2% or 0, dependent across the country for the full year of 2024. When we look at the new contracts, so these are just the homes that are going into contract each week. So that's $400,000. So if you look at the homes on the market, it's 450,000. You look at the ones that are buying, people are buying at 400 grand. And that is exactly that's where the investors that's the peak of, where consumers want to buy. Like $400,000 is exactly where we are. That is still up 3.9% over last year. It's up over 2022. So these are the earliest proxy for sales that are happening. So we can see that, the homes that are going into contract are right around $400,000. And we're showing a little bit of gain over last year. And you can imagine that this holds across the rest of the year. So maybe that's why it's like 0 to 3% home price gains. It's not showing strength like 6 or 7% gains. It's about 3.9% home price gains over the last year. We can also see, and I've highlighted in the chart here, the vertical bars in those period of 22 after June, rates had jumped. And if you were still on the market and you hadn't sold, the buyers were going like, I'm adjusting my buy box down, so prices dropped. And then again, in that September window, when rates went to 7.5 that year, you could see immediately in the new contract prices how quickly consumers reacted. So right now, rates have defied expectations all year. They're still in the 7s. They could go up again. If mortgage rates go up again, you could see this behavior from consumers who are shopping at 7% and now suddenly have to buy at 7.5. You can see this could drop again. So it's something to keep our eye on when we want to understand how quickly consumers are reacting to changes in mortgage rates. Now let's shift to price reductions and then we'll go into the local data. Currently, 33.7% of the homes on the market around the country have had price cuts. That is not alarmingly high, but it's higher than any May in the last decade. More homes on the market now have had price cuts than in any time in the last decade, in any May in the last decade. We could see the light red line is 22. That's when rates were skyrocketing and inventory was skyrocketing and price cuts were skyrocketing all at the same time. And you can see how quickly price cuts were rising. It's not rising as quickly now, but it is still elevated and it is certainly rising more quickly than last year. So if you have sellers who are still in a mode of trying to go fishing, the price cuts is a very effective means to communicate with them. Like, look, if you want to sell this house, we want to be ahead of this curve, not behind this curve. We want to price this house right from the start because more and more of your competition is cutting its prices. Now, and so it can be very effective to sit there with your market report in the listing presentation and say, look, here's why you need to take my recommendation on where we're going to price this house. 33.7% of the homes on the market have had price cuts. This 30 to 35% is totally normal across the country. It varies per market. And so let's look at the different markets and dive in to some of those really fascinating things. So I've got the Altos product open here. I'm not going to go through the reports. I have advanced analytics as the window open, and in advanced analytics, I've set up my queries. I have the ranked 50 markets with the most price cuts, and I want you to see if you can see this pattern. So price cuts are rising, 57% in Sarasota, Punta Gorda, Tampa, Fort Myers, Naples. This is all Western Florida. Now we get down to Central or other parts of Florida. The first non-Florida market with price cuts is Phoenix. But then it's back to Florida, 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 Florida. Down here, okay, Indianapolis and Austin. But both interesting, both Austin and Phoenix generally have more price cuts. Around 40% is normal for those markets. So 46% in Phoenix is not a ton, but it's softer than normal. And it's softer than we have multiple years here. We have a 3-year window on this. You can see that 3 years ago, only 15% of the homes in Phoenix needed price cuts because it was peak pandemic and we're buying everything. Now 46%. But in 22, when the market was really slowing down, 63%. So you can see how much better Phoenix is than it was a year and a half ago, but still in this slow. Really, the message here is Florida. We have a lot of things going on. So I've talked about how the South, especially Southwest Florida, may be the coolest part of the country right now. But what's the hottest part? Last month, I mentioned Boston, but let's look at San Jose right now. Silicon Valley is on our market action index is a 70. It's like very tight inventory for the available for the buyers. We can see median days on market is 14 days. We can look at our price reductions in San Jose. 16%, 17%, the fewest of the big metros in the country. San Jose has the fewest price cuts right now. This is like pandemic levels, not quite pandemic levels because there was 4% with price cuts. Now there's 16. But like, let's look at inventory levels. So inventory is up just a little bit over last year, 800 homes versus 700 a year ago. So, 10% more. And so loosening up a little bit, but fewer homes than in 22. So the market in San Jose is very cash heavy. It's been a really strong year for tech stocks. NVIDIA is at $2.5 trillion company now. They have maybe 20,000 Silicon Valley employees. Um, and those folks have a lot of cash. And that's just NVIDIA. That's just one company. So we can look though at the price range. Anything under $2.5 million is going in 14 days. Now the $5 million homes might take a month. You can see exactly where the demand is. The stuff under $1 million is older and smaller lots, and that's time goes up again. So San Jose may be the hottest market in the country. I was thinking about that, except then, what if we look at Seattle? And Seattle is also right around a 70 in the market action index. Price reductions in Seattle are at 20%, 21% right now. Excuse me, the more than the pandemic, but still very strong. And if we look, for example, at price per square foot, we can look and see where Seattle is hitting new highs in price per square foot. And we can see this, anything under $2.5 million in Seattle, 14 days. So maybe Seattle is the hottest market in the country right now. Very interesting. Let's compare that or contrast that to Sarasota. So this is inventory in Sarasota. Sarasota is right about almost balanced market in our market action index. This is inventory in Sarasota, up from 2,500 homes to 5,300 homes. So like 100% inventory increase in the year. 100% more homes on the market. We could see the days on market in the price range, 60, 70, 80 days. Very different markets than the cash heavy West Coast tech markets. In Sarasota has a lot of second homes. They have a lot of investor activity. And so second homes means if I have rising property taxes, I have rising insurance costs, and I have a second home in Sarasota that I don't use very much, my costs are up dramatically. I may be much more tempted to list that home and sell it because I'm experiencing, I'm afraid of climate risk, hurricanes. I may be more likely to list that home and sell it than buyers in, say, San Jose, who are building their family now with their stock wealth in their professional space. So Sarasota, Southwest Florida, may be the lightest market in the country. Let's look at some sort of middle markets. Here's Atlanta. Atlanta is a 48 on our market action index. You can see Atlanta inventory from just about 10,000 to just about 14,000. So 30, 40% more homes on the market in Atlanta, but still fewer, significantly fewer than pre-pandemic. So you can understand what's happening in Atlanta, and we can see that reflected in the days on market. You can see that $380,000, $400,000 price point that I mentioned earlier. Atlanta is that key part of the market. It's an investor heavy market. It has a lot of those investor buy boxes. And so we can see exactly where the demand is in the Atlanta metro region. I mentioned Phoenix. Phoenix has more price reductions than many of the other parts of the country, but you can see fewer price reductions than, this is 22, look at how dramatically how quickly Phoenix was slowing from crazy hot as rates rose in 22. Now we're much more stable range. You can see normally Phoenix is about a 40, 41% with price reductions, and we're at 46, 47 right now. So it's a little cooler than normal, right? This is not a hot market, but it's not cratering. And if we look at inventory in Phoenix, we can see a lot more inventory than last year, 6,000 to 12,000, but still way fewer than pre-pandemic times. So you can understand why Phoenix is kind of a mixed market right now. And we really have this sort of, like I said, tale of three cities. Now, I mentioned Arizona is 60% more homes on the market than a year ago for all of Arizona. And you can see it right here, like in Phoenix, the Phoenix Metro, up from 6,000 to 11 or 12,000 homes listed. I've also got Minneapolis open, and then we will wrap it up and do some questions. So Minneapolis is another one of the mid markets in the middle of our. If we have a tale of three markets this year, we can see in the Midwest and the Northeast. Let's see, inventory is just starting to come off of the pandemic lows. But as I mentioned earlier, basically everywhere in the country has inventory growing and inventory growing over last year. Only Nevada and New York still have fewer homes on the market than a year ago, but those are climbing, and I expect those to turn positive soon. So 3,400 to 4,400 in Minneapolis is a third more homes, but still half of what there might have been a few years ago. We can look at the price cuts in Minneapolis, and we can see that we're right in a normal range in the 20s, on its way up to the 30s for the second half of the year. Not as good as the pandemic, but still still in a very normal range for Minneapolis. And we can see in Minneapolis, we can see the demand here, $400,000 and under is exactly where America wants to buy its homes. Let's stop there, and I will just let me remind you that you can go, if you are new to Altos and you haven't yet downloaded the ebook, I recommend that you go to the link. We'll post the link in the chat to go use the ebook to understand how to use this market data in your business. We have scripts, we have ideas, we have explanations about the data and how to talk about it. It's the stuff I talk about in these videos. So I recommend you go to that right now and download that and make sure you're using it in your business. And if you aren't yet working with us at Altos, you should go to the altosresearch.com and book a demo with our team. Get a free consult. I can't go through every local market here in these, but we've got every zip code in the country. So let's look at your local market. Yours, and I point out how some of these markets are super hot right now, and some of them are super cold right now. So what do you need to be telling to your buyers and sellers right now? And that's what we get to do in that free consult. Book that with us, and we can get started today. All right, everybody. Thanks. I'll stick around in the chat for a few minutes. It'll be recorded, and